Hello, folks. Brandon Chapman today. It's another Theo Night video for Monday. What is this, January 9th? 1 week away from the middle of January, Martin Luther King Day and all this stuff. The Fed is, the market is tripping. We're talking about round tripping here. We rallied, we faded, we basically closed unched on this session. This is the ES futures. The video title is Tech-Led Rally Fizzles with Powell and CPI on deck this week. There's a lot of news, and you can see the trepidation. But despite all this, the bias is still to the upside. And when I say that, it's based on volatility indicators. So, for example, the VIX 3M to VIX ratio, which you'll notice is we're about 1.08. All that means is that the ratio of the 3-month to the 1-month VIX is basically in the middle of the range, with 20% or 1.2 or higher being more of a level that's indicative of anticipating a market sell-off. We hit that on December 2nd. We hit it back here in August, the pivotal August 12th day, really indicating a reversal in the market. You can go back here to the end of March as well. All of these provided, pretty decent indications to say, hey, time to take profits, time to anticipate a 5 to 10% pullback. We're not there yet. And you look at skew, and of course we don't have the updated skew figure for today. But what you're seeing is we did see skew tick higher on Friday to 113, 114. 130, like this 127, 130 would be high. We're nowhere near that right now. So there's nothing right now that's really pointing to a lot of trepidation in the market. It seems like there's a desire to want to be long. And as you notice, this is a level I called out back here on December 19th as being a critical level. Why? There was a 1 million print at this point. The market skidded along that level for a couple of weeks, finally broke out on Friday, trading higher today. And where do we go from here? I mean, we rallied, we faded. This kind of reflects the cash session. I was thinking of maybe 400, 410. The bearish conditions of the market certainly suggests 480 is probably not likely. A retest of new all-time highs is probably not likely. But the realities right now is that there is a bullish bias. Now, what could take this away? Well, we got him talking tomorrow. We got Fed Chairman Powell speaking tomorrow morning, just after the market opens. About a half hour before the market opens, 9 o'clock Eastern time. And he could move the market. The question is, are they going to accept higher levels of inflation? There's been this anticipation of this, but certainly if you look at a couple of Fed heads that talk today, like Bostic, for example, he's suggesting that the Fed funds rate should be 5 to 5.25 through 2024. And certainly this doesn't really dovetail with what the market's pricing in. I mean, just look at bonds the last couple of days. Right? Yields have been falling. Big buying spree last Friday. Again, yields dropping today. The 10 years at 3.5%. What's the 30-year right now? TYX, 3.65%. Where's FVX, 5-year, 3.65%. We're still dealing with an inverted yield curve. Yes, 10 years not above the 30 and 5 sitting on the 30 right now. But let's look where the 3-month T-bill is. 13-week. 4.4%. Okay, so when you think about this, what you're realizing is that, look, the market is not pricing in the same expectations as the Federal Reserve. And as you look at the inflation, this is the CPI. So if you look at, this is just Econo Day, Jerome Powell speaks. We got CPI, big news there. I'm really keying off jobless claims to see if those start to tick up. But again, you look at inflation expectations. Year over year, it's 6.6%. But look at this, consensus of 0. What is this telling us? The market's not expecting any inflation. We're doing this month over month comparison. The year over year is still big at 6.6. But if this surprises to the upside, watch out. We may sell off if the market's expecting the Fed to remain more hawkish. Because right now, what we're not seeing is the market's not expecting or pricing in major rate increases. So, for example, we're currently at 4.25 to 4.5%. This is the CME Group's page for the 30-day Fed funds futures pricing and what they think the Federal Reserve, the Fed funds rate is going to be. 80% they raise a quarter point in February on Feb 1. March 22nd, what are we pricing in there? 67% chance we go to what? 4.75 of 5%. Maybe we overshoot to 5, but it's pretty balanced. We either stay the same or overshoot. The odds on bet is we raise another 0.25% in, or 25 basis point in March. Go to 30 May. Well, 50% chance we're at 4.75. We're not pricing in going another 0.25 point in May. It looks like we're pausing for the moment at 4.75 to 5%. Look at June. We still have the pause, greater than a 50% chance we're at 4.75 or 4.5 or below. Go to July. We're still stuck here at 4.75. We're pricing in a greater probability of 4.5 to 4.25. So what's happening by September? We're now pricing in pretty decent probability there's going to be a rate cut by next fall. And look at November here. Scroll down, right? 4.5. We're now pricing in effectively a rate cut. 33 plus 19 is 52. Add another 5 to it. We're starting to price in a higher probability of rate cuts peaking at 4.75 and cutting by the end of the year. This is November. And so what is the market saying right now? And these probabilities have shifted a little bit, haven't they? So look here, for example, we had 15%, now we're 11 to, we're really shifting down here to a higher and higher probability we're going to see a rate cut. We've not been above 50% probably for a while now. So a lot of stuff could happen today to change or reshape these expectations. And as you look at the market's rally today, this is really coming down to the fact that, look at XLK. Bring up technology. This is the best performer today, 1.16%. A lot of this has to do with the repricing of those expectations, providing the accommodation, starting to cut rates, and yet what we're getting from the Fed is entirely different. And so again, a lot of people are going to key off Powell's statement tomorrow. And from my perspective, that's probably the biggest reason why the market faded here, and technology only ended up 1.16%. And if you look at technology along with cyclicals, there were two sectors were one of the highest beta sectors over the course of the last year. And of course, technology's really been beaten down over the last couple of weeks here. So they got a bit of a reprieve today. And it was really specifically the area of leadership was in semiconductors, which is kind of what you expect. Semiconductors typically lead. This is an area a little over a week ago. I pointed out some unusual bullish option activity in SOXL, and it kind of waffled here and then eventually broke out on Friday. You saw more bullish activity come in SOXL today. I don't really encourage people to trade SOXL, but it can be used as a sentiment indicator based on its option activity. But two semiconductor stocks I wanted to call out here are AMD. Now, AMD did not finish as much off their highs, but still finished off the highs. And today, and again, I have a scan that I use to identify this type of activity. And again, I guess we can scroll up here and show you, like an AMD, for example. As you kind of roll through this wasn't quite as robust earlier in the day as many, but you can see the volume, for example, in here, right? How much volume was traded. You got the symbols here, and I'm on a different computer, so I'm showing all this stuff over, which I don't normally do. But usually I show volume and open interest as a field. But again, you see all the activity here on the call side, 69 through 75, a couple on the put side as well. But the area I want to kind of focus on here is the 13 Jan. Now, granted, this is weekly. That's for this week. This does have some of the highest gamma potential, but look out here at the 75 strike. Again, saw a lot of buying interest come in at that strike price today. Again, does that give a potential target? We'll look at 75, get you back to about prior highs. So if Powell comes out tomorrow, yeah, he could kill this. He might even create a little bit of a soft kind of pullback, but look at the possibility until we start to see volatility conditions really steer towards more hedging activity, more expectations for volatility. A retest of prior highs in AMD seems like a reasonable expectation, along with NVDA. And this is one that, again, had bullish option activity last Tuesday or Wednesday here, broke out today. And also accompanying with that was some significant option activity And sometimes you see that it starts out on one strike, and as we start to break through it, it starts to roll out. We ended up finishing back at the 155 strike here, 11,000 contracts and 33. You can see it building our 160, 165, 170. So just kind of building every $5 out here. But this is where it kind of kicked it off this morning right off the bat. And again, we're looking at 170. Could we run to potentially test 186, 185 up here? That may be a possibility, but at least in the near term, a 2/3 retracement is pretty reasonable. So if we get some selling and kind of retest of lows, look for the price to firm up, and we can maybe see a run to 170 pretty reasonably over the next week. And this is a lot of this activities for today. And a lot of what kind of created some of this momentum is a lot of weekly call activity that happened today and some key stocks kind of driving things a bit. But again, most of these companies did fade from the highs. And as you look at sectors, I mean, boy, healthcare is in there as being a poor performer today, breaking support, and staples. We get this kind of dark cloud cover type formation. We didn't quite gap up above the high, but anyway, we're seeing some bearish price action form on good volume today in staples. And so as what we're seeing is, again, some potential for rolling over in some areas just naturally. But today's fade towards the end of the day definitely hit staples, definitely hit healthcare. Industrials also kind of reaching a resistance point, fading back. Utilities ended up kind of hanging in there. Stocks like Southern, I've been talking about for a number of weeks here, being bullish on utilities, thinking we might have a chance of getting up here. But everything depends on, okay, what happens tomorrow with Powell, what happens on Thursday with CPI. And again, if the data starts to confirm the potential of the Federal Reserve pulling back like the Fed funds futures are pricing in, we may see a bit more of a squeeze in the markets higher and may help carry these companies higher as well. Now, as we look at cyclicals kind of being a middling performer and staples, let's kind of isolate a couple of companies that are in this space. We'll start things off with KHC. And, Kraft Heinz has done very, very well, right? We've made a huge run. I drew this fib projection based on the seed wave back here. It's one that we had seen previously, some bullish call activity, and kind of laying this trend out. This is kind of that next wave there. You get a pullback. The next wave you expect to carry to 223 to 261. And that's kind of where we're at right now. I mean, what you would have expected in terms of a trend based on this initial seed wave back here, you've met that, right? Now there's potential. We could get maybe a bit higher here, but the fact of the matter is we've achieved the potential of this trend. And so, we had a really, really strong run last week in KHC. So as we look at the trade today, it gets a bit interesting because, puts are sizzling 2 times the average, 47% at the ask. I mean, it really starts to kind of point out that, hey, what goes up must come down at some point. Okay. So as we look at February, notice out here, 6,400 puts mostly bought today at the 40 strike for 17 Feb. And, it starts to create this thought is, okay, are we looking at a potential reversal here in KHC? Now, 43 is not exactly out of the money. It's not exactly 40. It's not exactly super far out of the money, but it does provide some potential downside here in KHC. Sorry, that was 43 for some reason. So what do we do? Well, if you look at the volatility skew, and this is something that at TheoTrade we key off a lot, because you have to understand is that you have to understand implied volatility in terms of strategy selection. So if you look at 42.50 and 40, well, look where the market is right now, 42.20. Okay, you're buying, you're buying 24% implied volatility, and you're selling 40% implied volatility. The spread costs less than 90 cents. Yeah, we're still above our break-even point, but the reward to risk is favorable. So if I click here, go buy vertical, you'll see that this costs about 87 cents. Okay, 87 cents on 250. So if we run to 40, it provides an upside here of about what? $1.38 to what? 87 cents of risk. So, so that's more than that. Sorry. $1.50, $1.63, right? So take 250 minus 87. That's your max gain. Point being is that the reward to risk is significant because the vol skew is going for you. And this trade's got a little bit less than a 50-50 chance of breaking even, but your break even is what? 87 cents minus 42.50. So again, we're not too far away to be able to break even on this. It does not require much downside movement, and the reward to risk is there. Now, if you achieve that, 30% of the max gain in the first few days, take it off the table. If you get towards 50% after the next few days, take it off the table. But the idea is if we move to 40, you're definitely there in terms of the reward on that. And that's what we call an in-out spread. Another one here as well. This is more in retail. This is in the cyclical space. But Ralph Lauren had a big bounce here back to prior resistance, faded today from the high, and the activity, again, was a February expiration. Sorry, clicking on the wrong button there. Is a February expiration, or 17,000 contracts at the 90 strike price. And again, look at the rising vol term structure. Again, this allows you to construct these kind of vertical spreads very favorably. Again, at the money, 115, 110. Costs you about $2.20 on a $5 spread. Again, your reward is greater than your risk. Your break even is going to be down a little bit towards a 113, but again, it provides that kind of downside expectation without needing the stock to just completely come unglued. A run towards 110, towards 105 would allow you to comfortably exit that trade with the stock at resistance fading today. Now, you might wait to see how the market shapes up after the Powell's discussion tomorrow. But again, these are some bearish setups on two sectors. Again, cyclicals and staples here, and probably shouldn't perform like technology. Now, staples may underperform more so if the market's more bullish, but either scenario, again, we're looking at some bearish activity on these particular stocks today. A couple other ones to look at right now in the energy space. Again, if you look at forward/CL, what you see is that oil did kind of firm up down here at 72.50. I was really expecting that RBOB would start to wilt relative to oil. What you'll notice here, this yellow line, this relative strength line, is that kind of the prices of gasoline and oil have been performing relatively similarly. And as a result, you have companies like VLO, a refiner, still kind of hang in here, albeit at resistance. So I'm looking for this to reverse. But there was some big trade today in XLE, and we'll circle back to Oxy and Rig. But XLE kind of fading at resistance here. If the growth dynamic, again, if economically we're starting to see a bit of a turn, this could end up being, relatively negative for energy. I just don't see oil prices going down as much. I do see the idea that we're starting to see, oil service companies starting to pick up. That's been kind of a theme of mine for the last couple of weeks. And specifically stocks like Tusk, and that was back here at the lows, and Rig as well. Rig had a big day today. But despite all that, XLE, there was some bearish trade today in XLE for a January expiration down here at the 84.50 strike price. And again, it's one of those things where, this could be just hedging activity coming in, worried about a potential decline. This is a bearish indication. And yet you have companies like Rig that saw, some significant bullish activities, had a huge 3-day run here. Again, are we starting to see an expansion in production? Again, you've heard kind of data going both ways, but look here, traded the ask, about 51% traded the ask. We're sizzling today, 4.8 times the average. And we're talking about an August expiration out here a little ways. So we're reaching a little bit more. And this one was kind of a ratio. It was a 6 and an 8. We did see more action kind of pick up there, but the spread itself, if we look at option time and sales, 6,000 at the 6, so selling 8,000. The January, I believe, was closing. Sorry, no, that's a different one. Yeah, it's closing activity out there. So again, we're looking at opening activity there. Also on rig, a 13 Jan. So for this week, some buying activity, the 550. So a lot of stuff kind of fueling this big move. Granted, we're a little bit late to the game. But this is one to watch to see if we kind of retrace back in here. But 550 would be the target. We're getting close to that level. But we could see a near-term pullback. But watch the setup and rig. You know, stocks like Tusk. Tusk provides, sands for fracking. They landed a big deal back here, thus the rally. But we saw the big kind of pull down on Jan 3. We may consolidate here and then break out. I think energy will have its day, but right now I think what we're seeing is there's a bit of a overboughtness to it, and that's the activity you're seeing in XLE. However, Oxy has underperformed energy. It was higher today, did fade back, so you probably want to see a trade through today's high. But Oxy specifically, this is on the 13 Jan. It's a weekly action here at the 68 strike price. So again, some mostly buying activity there. So again, could we see maybe a pullback here and then a bounce towards the 50% retracement and a 68 strike price? That might be a pretty reasonable thing. So you might want to see in energy a little bit of a near-term pullback, and the XLE is kind of pointing to that, and then looking for that next setup as we start to roll further into January into February. We may see some nice rallies out of these companies that we're seeing, again, this activity coming in here. Finally, we're going to wrap things up with housing. Normally you'd see that, okay, if yields are coming down, that should be favorable for housing, interest rate sensitive parts of the market. Notice that real estate finished in the middle of the pack. Industrials are down today. If you look at XHB, this is the home builders index. Again, ran, faded. Those big components are like Home Depot and Lowe's that are just consolidating here, may break to the downside. And so again, it looks like a lot of stuff is hinging. Now, KB Homes, again, made a nice rally, right? We're back at prior highs, near resistance. It did kind of fade today. You'll probably want to see a little bit of follow through, hopefully tomorrow. And again, this is one that if it looks like Powell's going to raise rates, home builders could really be smashed. Anecdotally, if you read stuff out there, incentives are being picked up as you expect to see more inventories come online here. But if we look at KBH specifically in the options page, this one that doesn't have weekly options, not a huge amount of depth here, but the spreads are reasonably tight. But this 5,000 contracts here at the 32 strike for 17 Feb. And again, you can kind of look down here and see a lot of buying activity. This is stuff that you have to dig around with because it's not weeklies. My scan over here is set to weeklies. But again, you can change what you scan in up here to help identify other activity. But you can see a lot of buying activity today. You look at the option statistics on it, 67% at the ask, 9.5 times the average. And again, what strike price are they trading this one? It's a Feb 32, so we're looking at a pullback here. These create decent scenarios where, again, let's bring up Don's expected move study here. And I've got it set to 2 times the expected move right now. But notice last week we touched 2 times the expected move, which is a big move for the week. Blew out expectations. That's the 95% range level. And so again, this creates these kind of near-term opportunities to play a pullback. Now, again, is there a lot of depth in these markets, a lot of liquidity? Not necessarily, but again, you can look at like ITB, for example, as a proxy for home building. You can maybe look at something on that one. But if you come out here to February, again, 63, you could potentially buy a 65 and sell a 63. And that gives you a cost basis of about $1.05, right? You're already below your break even. A max gain would be achieved at 63 at expiration. If we come and test the lower end of the expected move here, you'd reasonably be able to get out of something like that. But again, you could look for a little bit of follow through you want, or you kind of play into this level with that kind of an out spread. Anyway, folks, that's all we got for today. Or I guess I got. Anyway, we'll catch you back next week on the video. Anyway, have a great one. Thank you.